So what's the significance of the start? I mean, I know it's an obvious question, but as you think through it, what are the opportunities as they start to ease?
So I think there's a global easing cycle coming, generally speaking. We saw it in London, we saw it in the UK, we saw it in Australia. Obviously, the moves expected by the Fed caused the yen carry trade to unwind, which is very technical. And it's good to see the markets calm down a little bit today from last week. And so pretty positive about that. Now, what we're really looking at is, in our view, a very restrictive monetary policy globally to reduce inflation. Mm-hmm. We think that's happening. We think part of that is supply chain related. You're going to see a normalization of inflation. We structurally believe inflation is going to remain higher.
So let me back up for a second. Do you think policy, what's more significant, the fact that policy is still tight or the fact that they're embarking? Does the yen volatility last week say to you, when you say expect the unexpected, that the cuts aren't some panacea? Are you seeing them as a sort of catalyst and a trigger in a positive way, or something to kind of be on the watch out for?
Yeah, I think you always see positioning in times like that, where you see a big move in the 10-year Treasury, for instance, going lower. And so what you see is where positioning is. I think we saw that move. The unexpected is, I still think we're in an environment that's very different from where we were for pre-2020, 2021. So we're dealing with a lot of issues, I think, that still emanate from that period. Mm-hmm. And so that's
like
where I get to, like higher
rates.
Inflation, structurally higher inflation. And we've sort of called it generationally higher inflation. And what I mean by that is, the past 20 years, 15 plus or so, if you had very low inflation, Fed funds rate very low, you had a good productivity. And what we see today, in our opinion, is a commodity cycle that's a little different, right? It's a little more uncertain. And you see, I think, structurally higher labor costs. Mm-hmm. And those two things to us are going to cause inflation to remain higher, which means the Fed has to thread the needle.
And we should talk about your stock picks because that's where the rubber hits the road. But I just wonder if the data the last couple of weeks or months is pointing toward, hey, maybe it can be more disinflationary than we thought. Look at commodity prices. Maybe China's a big part of the story. I mean, mm-hmm. even there, they were supposed to be behind the structurally higher labor costs. And you're like, I'm not so sure. So, but do you think the names that some of your favorites, does your portfolio have to be positioned for that thesis to be the case, or can these stocks work either way?
I think you have, like I said, very restrictive policy globally. So I think reducing that a little bit is going to help a lot of sort of corporate views on where they're going to spend capital. And also, a lot of that is, I think there's sort of pent up demand to put that capital to work. So it does need to play out. And we would also barbell this with some other ideas as well, because we think it's going to be very volatile.
You mentioned one of the kind of discussion points in the market right now, which is around if you wanted to get defensive, mm-hmm. what would that look like? I mean, should you be in staples, for instance, when there's some disinflationary risk with packaged goods? Should you be in utilities? But wait, do you want to be kind of riding the tails of the AI innovation for better or for worse there?
Yes, so we've been writing about this for a while. We're actually far more interested in the utilities here. And we see there's going to be an inflection in demand. We're on the precipice of this, of demand electricity use in this country, whether it be data center related. We had really flat electricity demand for quite a long time because of energy efficiency. So we're very positive on sort of the demand underlying current for utilities. We think that's coming. And all the investment that has to happen for that to occur is also very interesting. And that's what we see in the market. We're seeing people really invest in industrial companies that help that. But in our opinion, staples are really challenged here relative to utilities. So I'd rather own a utility, the group in general, to sort of barbell the portfolio, because I think we have better demand than we've seen in this market for a long time.